Real Country 1430 AM and 107.3 FM WRDN. I'm Bryan Winnikins. We are at the NAFB convention in Kansas City. Thank you to the Wisconsin Beef Council, also Wisconsin Pork Association, the Animal Wellness Center of Buffalo Valley, and Ashley Gaussman, our BASF representative serving Northwest Wisconsin. Joining us right now, Bryan Doherty with Total Farm Marketing, and we're going to talk with Bryan here a little bit about the dairy markets. And Bryan, a few weeks back we talked and I said, hey, it's been quite a long time since we've seen $19, and now all of a sudden it's been quite a long time since we've seen $20 on the board.
It has, 2014 to be exact. So it's a 5-year, let's call it window or drought of $20 milk, and it came and kind of went. So, but it's a reflection of that. We talked about this numerous times over the years. In my view, the longer cycle in dairy, as the operations get larger. It takes longer to grow the production, and it takes longer to reduce the production. So it took longer to reduce the production as you've got heavily capitalized dairies doing what they do best, and that's produce. Demand caught up to the marketplace is what's happened. So between demand and some higher corn prices this spring, some increased cow slaughter, lower production, it didn't take long for the market to respond. And when markets move, I think it showed once again that some things change over time, some things don't. Markets have a tendency when they really move to accelerate toward a topping window. I'm not going to call it top in dairy, but $20 milk, that's probably more than we wished for this year.
Now, one of the things that I've noticed, and it was kind of something that I was always brought up when looking at the dairy markets, is the non-fat dry milk prices. It's kind of like the canary in the coal mine. If they start to go down, that means we're putting more in storage for powder, which means demand's going down. When they start going up, all of that powder is going out the door, which means we could have increased demand. Am I right in that assumption, or that's kind of how I was taught?
You're right in that's a generalized assumption, and that is accurate. I think what's important to note here, when you take a look at, what are the drivers in the marketplace, usually you don't have one driver, though. So while that may be a driver or an indicator, just like you might talk about bond prices or something else indicating some potential change in the stock market, that's a force that needs to be viewed along with a number of other variables. What we're really excited about is the potential, if we can get things worked out with China, for that market to really open up. And really we're seeing that as our export channel right now. And that part of the world, the economy is slowing other parts. I was watching the Bloomberg News this morning, real concerns about slowing general economic conditions elsewhere in the world. Even with that being said, the market's really strong right now on all fronts. So when I talk about variables, we're clicking on exports, we're clicking on a little bit lower production numbers. This higher corn price we talked about, I just mentioned, that had some people really thinking here this spring. It was tough, and it is still tough to originate grain, and you know the silage story in the northern states. So you've got a lot of these little dots that you're connecting right now, and the market really responded well. We're just really happy with that. But it's a demand-driven cheese market that really, put the push under it. Well, why is that? Good economy. Maybe we talk holiday, Super Bowl buying, all that kind of stuff this fall. So we had a lot of dots connected. Now, I would tell you, I want to be a little more cautious as we head into the first and second quarter. Don't let this slip between our fingers.
Will the announced bankruptcy of Dean Foods have any play in this?
That's probably not in the long run, but it's a disruptive force in the short term, and it certainly makes everybody kind of pause and think. It's an area that I wouldn't profess I'm an expert at, but I would think reorganization, you pick up the pieces, you move forward. The question really is this symptomatic of more to come? Or is this just a one-off? It's a management issue, maybe some decisions that regrettably were made or something. So I think time will tell, but I would not say that is a driving force to change the overall economic picture that we see in the dairy industry, which is a real optimistic, upbeat. We've gotten that supply number down a little bit, and we're moving the product.
Finally, what should dairy farmers be thinking about here to take advantage of this? Because we all know this, what goes up real fast goes down real fast.
It does, and I'll go back to the general argument that I've had over time that a lot of times I get from dairy producers, especially from a marketing perspective. They say, well, we catch the highs and we catch the lows, so we sell the average. The market doesn't spend equal number of times at high prices as it does in low prices. So when we get these kind of rallies and push, you need to take the time and invest time and knowledge and dedication to think about ways to shift the risk, because when it shifts, and we've seen this in so many ag markets in the last decade in particular, it shifts so quickly, the bottom falls out so fast. So when the volatility rises prices, the old axiom is true: high prices cure high prices, low prices cure low prices. So we're encouraging producers to really be thinking about all of their marketing tools, including the new DRP insurance and what that can do for you. Looking at strategies, I mean, if we want to get specific, looking at investing in some put options, buying some insurance against those lower futures prices, leaving that top side open. If you're a little more risk savvy and maybe risk adverse, then you buy a put, sell a call. Challenge the market to go higher, Bryan. But we're in an environment where dairy farmers need to shed this, I'm not doing anything right now because prices are too low. Now is the time to really invest that time, energy, and communication with the right people that can get you there.
It's better to make something than to make nothing at all and end up losing money.
Well, we think it is. The grain farmer feels it more usually than the dairy farmer, because he sells maybe 2, 3, 4, 5, 6 times, 10 times a year, but the dairy's selling all the time. So again, the bias is, well, I have to capture these high prices. Well, that mentality comes from, I have to capture high prices because I've captured low prices. So if you can smooth that curve out and ride through those dips a little bit more comfortably, when prices do rally, you're in a much better position to shift the risk. That's forward thinking. I call that disruptive thinking. As we think about technology and industries and things that change over time, the disruptive thinking is what's different, what's innovative, what's impactful. What's impactful is taking control of your inventory, and that's really what a dairy producer is. He's an inventory producer of a commodity, milk, and he buys commodities, corn, meal, cotton, whatever. You got to control those as best you can. You have tools at your disposal.
Some great advice. Bryan Doherty with Total Farm Marketing from the NAFB convention in Kansas City. I'm Bryan Winnikins on Real Country 1430 AM and 107.3 FM WRDN.